So friends, let's understand the concept of capital gains in respect of slump sale. So listen, section 50B talks about the slump sale. Let's understand what is the concept behind this slump sale. Listen, say for example, normally, how do you compute capital gains? How do you compute capital gains? Tell me, what is the formula or equation to compute capital gains? The first thing required is full value consideration. From that, you can deduct direct expenses on transfer. Then you will get net sale consideration. From that, you can deduct cost of acquisition or cost of improvement, whatever it is. Then the rest is said to be capital gains. If it is a long term, you will get the benefit of indexation. If it is short term, you will not get the benefit of indexation. This is how you compute capital gain. Yes or no? When capital gain is required to be computed, there should be a capital asset. There should be a transfer as well. If there is a capital asset and that capital asset is subject to do a transfer, you need to compute what? Capital gain. Let me tell you one example. Say this is a company. Say I am a company JK Limited and you all are my assets and liabilities. You all are my assets and liability. Whether you are an asset or liability, that you yourself decide. Okay, you all are my assets and liabilities. Now, I am about to sell you to another faculty over there. Say there is another faculty in the other room. I am about to sell you to the other faculty for a value. Say what should be the value? Tell me some example. What should be the value? How much value should I put for you? 1 crore. Okay. Each 1 crore, not possible. I will say 10 crore. I put what? 10 crore lump sum value. Are you all with me? It's not individual value. Altogether, I put how many? How much? 10 crore value. And this entire business is taken over by the other faculty by paying me 10 crore. Now, if you ask me, say there is around 150 assets. There is around 150 assets here. Now, how many capital assets are here? 150. How many transfers are here? 150. How many computations do I have to do? According to the theory, conventional theory, 150 computations. Yes or no? That too, there is a problem. I don't know how much is the consideration for each asset. I have to apportion it also. This is a headache. So what department says, when an assessee is transferring his undertaking for a lump sum value without assigning individual values to the assets and liabilities, that will be considered as a single asset transfer. Technically, it is known as slump sale. It's not slump, it's slump sale. What is that? Listen, when an assessee is transferring a business or a business undertaking without assigning values to the individual assets and liabilities for a lump sum consideration, you treat it as a single asset. That entire undertaking have to be treated as a single asset and you compute the capital gain in a go. Rather than computing different capital gains, you treat it as a single asset transfer and compute the capital gain in a go. This is said to be what? Slump sale. Are you all listening? So what is the definition for slump sale? You are transferring the entire undertaking without values assigned to the individual assets and liabilities is called as what? Slump sale. Now listen. So this entire business is considered as a single asset. This entire business is considered as a single asset. Now listen friends. If the entire business is considered as a single asset, then the first thing that you should know is whether this asset is long-term capital asset or short-term capital asset. Yes or no? You tell me, how do we decide whether this undertaking is a long-term capital asset or short-term capital asset? Depends upon the period of commencement of business. If I commence this undertaking more than 36 months, long-term capital assets. If my commencement of this undertaking is 36 months or less, short-term capital assets. Are you with me? If the commencement of this particular undertaking is for more than 36 months, that means I've started this business for more than 36 months, then the entire business will be considered as a long-term capital asset, otherwise short-term capital assets. Are you with me? Another thing. Now to compute this, the first thing that you require is full value consideration. You require full value consideration to compute the slump sale taxability. What is full value consideration normally? You tell me. What do you mean by full value consideration in normal, common layman's language? So what they are saying is full value consideration simply means the value that I got, normally it means the value that I got when I sold you to the other faculty. In our example, it is 100 crore. But departments say it is not like that. When you compute full value consideration under 50B, there is a formula to compute the full value consideration. What they are saying is either FMV1 or FMV2, whichever is higher, have to be taken as the full value consideration. It is not alone the amount received. It have to be FMV1, that is fair market value 1, or fair market value 2, whichever is earlier have to be computed as the full value consideration. What is this FMV1? Listen, in one sentence, if you ask me what is FMV1, that is the fair market value of you, selling you to the other faculty. The net, what do you say, the net worth in fair market value terms is said to be FMV1. The net worth of the undertaking in fair market value terms is said to be what? FMV1. That simply means I am selling you. The FMV of the transferred assets is said to be what? FMV1. For that, there is a computational rule that you have to study also. Just like the exit taxation, we need to value how to take the FMV of yo. Are you all listening? So what is FMV1? Repeat with me. What is FMV1? The fair market value of the assets transferred is said to be FMV1. Net assets. Net assets. That means what? Assets transferred minus liabilities in prescribed manner. Now you tell me, what is FMV2? FMV2 simply means it is the fair market value of the consideration that I've received. Fair market value of what? Consideration that I've received. What is that? I've received 100 crores plus one building. I've received what? 100 crores plus one building. Then 100 crores money. That does not have any other fair market value. The value is 100 crores itself. Plus, I need to consider the value of the building as well. That is called as what? FMV2. That means FMV2 is the FMV of the items that I have received. What is FMV1? FMV of the net assets that I have transferred. Are you all with me? So we can say FMV1, assets transferred. FMV2 is assets received. Whichever is higher have to be taken as the fair market value. I hope it is clear. Now we need to understand how to value this FMV1. We need to study the valuation principle for valuing this FMV1. So let's understand how to value FMV1. For that, section 50 subsection 2 clause 2 is there. So friends, listen, let's understand how to compute the fair market value. There is a rule for that. That is rule 11 UAE is the valuation rule. Let's study the valuation rule, friends. What the valuation rule says, FMV1 equal to, this is the rule prescribed by the CBDT. Okay, normally the equations of CBDTs are fantastic. FMV1, they created an equation. A, B, C, D minus L. A plus B plus C plus D minus L. Forget about this A, B, C, D and all. We will consider what is FMV1. So what was FMV1? In one single sentence I've told you. What was FMV1? Net assets transferred fair market value. So the first thing that you are saying is, if the assets transferred is jewelry or artistic work. Say in my balance sheet, there was some jewelry and artistic work. What should be the value that I have to consider? Based on the valuation report, I should take the open market price. If I am transferring some jewelry or artistic work which is there as a part of my business, I can take the what? Open market price, which have to be, reported by a registered valuer. I myself cannot value it. I have to bring a report from a registered valuer. Now, if the asset transfers are shares and securities, then fair market value. Hope you remember exit taxation, we have studied a fair market value. What was the fair market value in exit taxation that we have studied? The listed equity shares, you take the average. Unlisted equity share, you go open the balance sheet of that particular company, value it, then multiply it by the paid up share capital that we are holding, divided by the total paid up share capital of that particular company. Hope you remember that. Are you all with me? So in the case of shares and securities, you find the fair market value in that as per that valuation rules. Say, now, if the asset that you have is what? Immovable property, then you take the stamp duty value. If the assets that you are having is what? Immovable property, you take the SDV, that is the stamp duty value. Then if you have any other assets like debtors, creditors, then cash, bank, then bills, receivables, etc., you take the book value. Any other assets, you take the book value, except income tax paid, TDS, TCS, advance tax. Why? It is not an asset that you can transfer. Can you transfer your TDS asset along with the slum sale? No. It is, you cannot transfer that particular item. So in your balance sheet, if there is TDS, TCS, advance tax or any income tax paid, you can remove it, you can exclude it. And you can exclude the unamortized amount of deferred revenue expenditure. I hope you remember what is unamortized amount of deferred revenue expenditure, which is a notional asset that we have discussed in exit taxation. Are you all with me? So listen friends, so FMV1 when you value, it's very simple. If it is a what? Jewelry or artistic work, you take the fair market value reported by a registered valuer. If it is a shares and security, then you know how to value that according to the valuation rule. Then if it is an immovable property, take the SDV, stamp duty value. If it is any other asset, excluding TDS, TCS, unamortized value of deferred revenue expenditure, then take the book value, excluding those two. For those two, you don't need to take any value. Now, it is in relation to liabilities. So, net assets means assets minus liabilities. Now, let's understand how to remove the liabilities. Listen, in liability, you take the book value of all liabilities except these liabilities. Liability does not have any other fair market value. So, what they are saying is, liability, you take the book value except the following liabilities. Number one to exclude is equity share capital. Number two, it's dividend or amount set apart for the payment of dividend to both equity as well as preference shareholders. Number three, reserves and surplus. Number four, provision for taxation. Number five, unascertained liabilities. Number six, representing contingent liabilities. Similar to what we have learned in exit taxation. So which are the liabilities that you have to exclude? Paid up equity share capital. It's not an outside liability. Basically, they are asking, indirectly telling you to take only the outside liability. So paid up share capital you have to exclude. Number two, dividend set apart, not dividend paid, dividend set apart. Then number three, reserves and surplus you have to exclude. Number four, provision for taxation you have to exclude. Number five, provision for unascertained liability. Number six, provision for contingent liability. Except this six item, you take every other liability's book value. Then you deduct it from the value of total assets. You will get FMV 1. Done. Are you all with me? Now you tell me what is FMV 1? The value of assets that I have transferred as per this rule is said to be FMV 1. Now let's understand how to compute FMV2. You tell me how to compute FMV2. FMV2 department say is again EFGH. A, B, C, D they have already used in the first one. Now they have the remaining alphabetical letters EFGH. Forget about EFGH. Let's understand what is this FMV2. So what was FMV2? The fair market value of the consideration that I have received. Now if it is money consideration, you tell me how to value it. Don't value it. 100 rupees value is only 100 rupees. Money consideration, you take that value. Don't apply any high-tech valuation method. Okay, don't apply anything. 100 rupees only have 100 rupees value. Then, if it is shares and securities, again, fair market value, same. If it is shares and securities received, the same fair market value you can take. If it is an immovable property, then you can take the stamp duty value. What is this immovable property? This immovable property is the property that you have received when I transferred this assets to the other faculty. Hope you remember, I am now about to sell you to the other faculty, and that faculty is about to give me what? Certain money, his jewelry, his chain, his watch, then his, his properties, everything for you, because you are so valuable. Let him suffer. Okay, then moving on. Next is open market price of any other assets. Apart from the above assets, if you have something else, then you take the open market price, like jewelry, valuable articles, etc. he have given me. Then you should take the open market price. So this is how you have to value FMV2. So friends, listen. Monetary consideration, you know how to value. Shares and securities, we know it is the old valuation method, the FMV valuation method. Then immobile property, you take the SDV. And finally, if it is any other asset, you take the open market value. But for that, you have to obtain a valuation report from the registered valuer. That value will be given in the question. The only point is you need to identify every value and compute it. Are you all with me? And this valuation rule you have to study. This valuation rule you have to study once they have tested a paragraph based MCQ question from this. Once they have tested a paragraph based MCQ question which carries, I don't know how much marks, 4 or 5 maybe, a paragraph based MCQ question they have asked. The same question is there as a numerical question, that we will solve it as a numerical question. Now, listen. So now you have the fair market value, FMV1 or FMV2, whichever is higher. Now you tell me how to compute direct expenses. I will write as usual. As usual, direct expenses. Why? What do you mean by direct expenses as usual? You take the normal brokerage, commission, etc. On the event of slum sale, say there was a broker in between. The commission that I paid to the broker will be considered as the direct expenses. As usual, there is nothing speciality in what? In the slum sale. Whatever comes as a direct expense in a normal transfer, you consider it as a direct expense. That's it. Now, you will get the net sale consideration. You minus F, V, C and DE, you will get the net sale consideration. Now, what is this cost of acquisition? What was the asset that I've transferred? What was the asset that I've transferred? Business undertaking. Yes or no? What should be the cost of acquisition? Department say, cost of acquisition shall be net worth computed in prescribed manner. Net worth computed in prescribed manner. That's what the department say. Net worth of that particular undertaking computed in prescribed manner. For that, there is another valuation rule. For that, there is another valuation rule, but that is very easy comparatively. So let's write that. How to compute the cost of acquisition. So we can write net worth. Net worth for the purpose of cost of acquisition. Net worth for the purpose of cost of acquisition. The formula is total assets. Total assets minus outside liabilities. Total assets minus outside liabilities. In total assets, you can split this into 4. You can split this total assets into 4. You can split this total assets into 4. So let's understand which is the first category. Let's understand which is the first category. So the category number 1, they say depreciable assets. Depreciable assets. What is depreciable assets? An asset where you have claimed depreciation in accordance with the Income Tax Act 1962, especially under section 32. So if it is a depreciable asset, then while computing the cost of acquisition, you take the WDV value as per IT Act. What is WDV value as per the IT Act? The remaining written down value which is computed as per the Income Tax Act after the claiming all the depreciation, how much is the carrying value? You should take that value only. Then, if it is an asset, where 100% of cost is already allowed as deduction. If it is an asset where 100% of the cost is already allowed as deduction, then you take nil value. What is this asset where 100% of the cost is already allowed as deduction? Tell me, what is that asset? 35 AD or 35 scientific research assets, etc., where you claim your entire cost of that particular asset in a go, then you take 0 as that asset's value. Then, third one, if the asset is self-generated goodwill, of business or profession, What is the self-generated goodwill of business or profession means? What do you mean by self-generated goodwill? It's a brand name that you yourself created. All right. What should be the cost? Nil. Nil. For self-generated goodwill, you are not supposed to incur. You don't have to incur any cost for that. But there is one point, friends. When you sell that self-generated goodwill, if you have valued it in your balance sheet, then you need to take the book value in computing FMV1. If you have considered, if you have identified that goodwill, you have valued it, and if you have put it in your balance sheet, then what you need to do while computing FMV1, you have to consider that book value as a part of FMV1. But while computing cost, the cost have to be taken as 0. Are you all with me? Now, and finally, there is any other assets. We can say other assets. Other assets, you take the book value. You take the book value. For other assets, you can take the book value. This is what the department say. Now we will discuss about the liabilities. Outside liability, you always consider the book value. Book value. Outside liability means excluding that share capital, reserves and surplus, etc. Whatever the outside liability is, you will take that and consider the book value always. All other outside liability, you can consider the book value. Now there is an important point here. While computing the total value of assets, if there is revaluation, you have to reduce the effect of revaluation. You have to reduce the effect of revaluation. What do you mean by reduce the effect of revaluation? You have revalued a particular asset. If you revalue a particular asset, your net worth will go high. Since this net worth is your cost of acquisition, indirectly you can claim a higher cost of acquisition by simply revaluing an asset. Yes or no? If that revalued figure is there, you need to reduce that revaluation and bring back to its original value. If there is any revaluation that you have done in your balance sheet, for those assets, while computing the net worth cost of acquisition, you need to bring down that revalued addition and make it the original value. Remove the effect of revaluation from the asset value. Are you all with me? Are you all with me? So you need to remove that effect of revaluation. You need to bring it down. Now there is another point. Even if this business undertaking have been commenced for more than 36 months, I cannot claim the benefit of indexation. No indexation benefit in computing slump sale. No indexation benefit. I cannot claim the benefit of indexation when I compute slump sale, even if it is a long-term capital asset. Now you tell me, what is the rate of tax if it is a long-term capital asset? 112, 20%. What if it is a short-term capital asset? Since depends upon, not 15. 15 is for 111A, listed shares, listed equity, listed unit of equity oriented fund, listed unit of business trust. Short-term capital gain, normal short-term capital gain. It will be treated as the slab rate of that particular asset. If I am an individual, my slab rate. If I am a company, 30% or 25% depends upon the case. From a foreign company, 40%. Partnership firm, 30%. Are you all with me? You have to be careful with the taxes. Now, listen, these are the things that you have to consider while computing the slump sale. And one more thing, this cost of acquisition have to be certified by a chartered accountant. A chartered accountant can certify the cost of acquisition according to the law which is mentioned under 50B of income tax. I hope this much is clear. This is all about the slump sale that we have to learn. Hello my dear friends, this is CA Jose Kurian. This video is to inform you about how to purchase direct tax law recorded lectures from our website. Very simple, you take your browser, search for CA Jose Kurian, then click on to www.cajosekurian.com. That is our website. Then from the website, you click on the classroom. From the classroom, you select your applicable course, make the payment, and the course will be yours. So if you come up with any doubts or require any clarifications in relation to this, you can connect with me via WhatsApp, Facebook, Instagram. The tabs are there in the website itself. You can find it in the sidebar. Now friends, let's crack direct tax law and international taxes together. So stay tuned, bye-bye and take care.